welcome to a very special and urgent edition of Indianomics. The Reserve Bank on Thursday announced that banks and NBFCs have to set aside more capital to back unsecured loans, that is personal loans and credit card loans which don't have collateral. Now the words the RBI uses, the jargon is that risk weights on these loans has been upped from 100% to 125%. Basically, it means 25% more capital. Reserve Bank has also said that risk weights on bank loans to NBFCs is being upped from 100% to 125%, or a little more for various other categories. It has asked bank boards to draw up a policy as to how much may be lent to unsecured categories. So it's brought a lot of signaling that unsecured loans should be lent very carefully. Now, what is the impact? Will loans become expensive? Will consumption fall? What's the impact on NBFCs? For a many-sided discussion, I'm joined by the biggest name in banking, Mr. Dinesh Khara, Chairman of State Bank of India. He's joining us all the way from London, and it's early morning of there. We are deeply grateful. Also joining us is Diwanji, the Group President, Head Consumer Banking at Kotak Mahindra Bank, Mr. Sitaraman, the Senior Director and Chief Ratings Officer at CRISIL Ratings, and in a bit, Mr. Revankar, who is, of course, Chairman of Shriram Finance, but who also heads the FDIC. So, in a way, he is speaking for the NBFC sector. Gentlemen, thank you very much for your time. Deeply grateful to you, Mr. Khara, for getting up early for us. First, sir, what is the immediate impact of what the RBI has announced? Will your loans to unsecured borrowers and to NBFCs become expensive? If yes, by how much?
Well, I think the most important component is that the risk weights have been increased from 100 to 125% in case of unsecured loans. But I would also like to mention that pre-COVID, this was actually 125%. During COVID period only, it was brought down to 100. And now they are back to 125%. So that is one of the major aspect which has to be kept in mind. But also at the same time, the concerns which are being raised by Honorable RBI Governor relating to the growth in the unsecured loan in the system, I think to that extent, this effort is to ensure that the system stays insulated from any potential risk. That is the reason why perhaps this risk weights for the unsecured loans have been increased, and also the lending to the NBFCs also, in whatever rating they are, it has been increased by another 25 basis point. But so that's how this is all. This is the broad import. So how does it impact for a bank like us? We made some back of envelope calculation, and our assessment is that as far as the unsecured loan book is concerned, it will have an impact of about 30 basis point on our, as far as the capital adequacy is concerned. It will consume more capital for the same level of loan book which we have. And when it comes to NBFCs, it would be, we expect it to be somewhere around 20-25 basis point. So that is how it is going to impact as far as the capital consumption is concerned. While saying so, I must also mention that if we, just to give a comparative, it is, we look at our half-year profit, so which has actually added the capital adequacy to the extent of about 109 basis point. So I would say that even today also, irrespective of the increase in the risk weights which have been announced by the government, it will probably have a situation where we'll have sufficient room to support the this existing book as well as to support the growth going forward.
Okay, that's good to hear, sir. But can I just get some details out of the way? Many brokerages have written us notes, and they say that your capital gets eaten up to about 58 basis points. Is that a fair calculation? You were 12% tier 1 and now you will become 11.4% tier 1. Is that ballpark correct?
No, this is what I was mentioning, that 30 plus 25 is what my estimation.
Yeah, 55, yeah.
55 basis points. Okay. So it could be 2-3 basis points, 5 basis points here and there. Okay. That could be there. Okay. But the point is that as of now, we are not really accounting for the profit which we have earned in the first half.
Yes.
In our capital adequacy.
Yes.
So my only point was that if at all we reckon that,
yeah,
then we actually go up in terms of capital adequacy by about 109 basis points.
Yes.
So as compared to that, this new guideline will consume our capital to the extent of about 55 basis point.
Fair.
So we are still comfortably placed, and in any case, we have got our plan of action for raising tier one bonds also.
Okay.
So that is much on course, and we'll be in a position to raise that also very soon.
You answered the next question I had in mind. Will you be raising capital? You will be raising tier one bonds. People were wondering if you will also divest in any of your subsidiaries. No such plans now?
As of now, no such plans, because these are I mean, as of now, we have nothing on cards for all those subsidiaries.
But your loans to NBFCs will become expensive by how much? You will raise it by about quarter percentage point, ballpark again?
We will work it out, because it will depend upon the rating of the NBFCs and the unrated NBFCs, because there's a differential treatment which will be there.
Okay.
So accordingly, we'll work it out.
Okay.
So it's still early. We have not done that kind of a calculation.
Okay. So I'm just coming back to you on the impact on the macro economy. But Mr. Umesh Revankar is there, and he represents the FDIC, the broad set of NBFC companies. Mr. Revankar, good afternoon to you. You're joining me from Singapore, and thank you very much for sparing the time. What's your sense? Do NBFCs face a double whammy? Cost of funds become expensive because banks will charge you more, and you have to keep more capital. Are we right?
Yeah, by and large, it looks like that. But most of the NBFCs are well capitalized. I don't think there's a hurry right now for increasing the capital. But yes, bank lending to NBFC becomes a little expensive. Then we need to pass it on to our customers, because typically NBFC work on certain margins, and we immediately pass it on to the customer, because we are most of us are in niche segment. Being in a niche segment, passing on becomes easier, but the growth momentum can slow down because of this. So there could be lesser demand, and the growth can come down. But I would like to highlight here is most of the NBFCs, they are into lending into business or not for consumption.
Yes.
The consumption loans are very small portion of NBFC lending. So if you take that as a factor, I think NBFC may not be directly impacted, because most of the lending goes into for business or acquiring asset, or for improving the business through working capital. So I think RBI is focusing more on the consumption loan, which probably they feel that it's getting overheated.
No, I take your point, but I think you're speaking more for yourself. Some brokerages, I think Morgan Stanley report said that you are only 4% of your loans exposed to personal loans and consumer credit. But that won't be the case for Bajaj Finance, which has a little more. SBI cards, 100% is unsecured. I mean, they have to keep 125%. So first, my apologies to Krishnan and Virat. Since you are in Bombay, I'm taking some liberty and going to people who are at unearthly hours obliging me. Mr. Khara, on that point, sir, since companies like SBI caps and generally in credit card, the capital becomes more, do you see a slowdown in consumption?
See, over there also, our capital adequacy ratio is somewhere around 22% plus.
Yes.
So even if we reckon this impact of 4%, we would be somewhere around 17.5 to 18% kind of a number. So I would say, because as far as the regulatory prescription is concerned, it is at 15%. So again, in that company also, we are also evaluating the option of raising tier 2 capital. So I think that is something which will be depending. We'll make an assessment of what is the growth plan and what is the additional capital required. So even that also will be addressed. So I would like to say that as of now, despite the increase in the risk weights, the credit card company also has got adequate capital adequacy ratio to support the current levels, and also to really support the growth in their business. But however, since we were keeping sufficient cushion in the past as compared to what the regulatory prescription is, we will be shoring up that through either tier 1 or tier 2, depending upon how what will be the requirement.
No, that's for SBI cards, but I'm more asking you the macro question. Do you sense that consumption will slow down a bit?
See, essentially, the consumption slowdown will depend upon the cost of credit at which these kind of loans are being made available. So there also, apart from the base cost, there's always a risk premium depending upon the risk rate in which the borrower is. So that is also one of the consideration. But I think what is being attempted through RBI is that indiscriminate lending for consumption should not be there. It should be essentially to those who are well-rated entities, and that is something which is being attempted in this whole process. I think I don't expect that it will have a. I would say that when it comes to the healthy consumption, it will not have any major impact, and more so. The major drivers of consumption, which is essentially education loan, home loan, etc., they are all exempted from this one. So I think they are the major drivers for growth in the economy in any case. So I expect that it will continue to grow as they were growing in the past.
Oh no, absolutely. Housing loans, realty is on an upswing, so that's not been affected. And like you say, car sales had done so well in October. That's again not affected, as you point out. Let me get to Krishnan. Krishnan, thank you for your patience. Is anyone constrained to lend now? What do you see as the main impact? Loan volumes, I mean, I think RBI's last Friday number was some 15.5 or something credit growth. Does that come down now to 14 or something?
Yeah, good afternoon, everyone. Thanks, Latha, for having the show. Now, this entire risk weight increase, I don't think it's come as a surprise to the wider market. The RBI governor in the last monetary policy had also called it out. And as Dinesh was mentioning, even before COVID, these loans, consumer loans, were going at a risk weight of 125%. It had come down, and now we're going back to status quo. And a significant portion of the retail loans are out of the ambit. Like, for instance, housing loans, vehicle loans, education loans, gold loans. For NBFCs, microfinance loans are also out. So if you look at the overall part of the retail book, which will be subject to this credit of the banks, which will be subject to this higher risk weight, that is roughly 30%, or it will be some 8-9% of the overall loan book. So if you look at individual banks, the amount of capital, additional capital that we need to keep is not very substantial. I would say that this particular guidance or this particular circular is more towards proactively recognizing the potential risks which are there when unsecured loans build up, and have adequate guardrails in place so that we don't have potential future asset quality.
Of course.
And you have adequate capital to manage that. In the past, where we have seen high growth in certain sectors, it has been followed by NPA increases. So I think today that's a proactive step to do that. Some impact may be there in credit growth. Our projection for credit growth for this fiscal for the banking system is somewhere in the range of around 13.5%, which is somewhat lower than what we are seeing in the current run rate.
Okay. Well, I know the bankers and the NBFCs have capital constraint. I have a commercial break constraint. We will make it a very short break, sir, but we are back in a jiffy.